Okay, I wanted to go ahead and revisit the cost method now that we've got subsidiaries acquired at other than book value. And let's go ahead and start with a case where it's a wholly owned subsidiary again. Now, having to learn how to prepare consolidations when the firm uses the equity method and then having to do it again using the cost method seems like a lot of effort. But in reality, it's really not that bad. We simply have two minor modifications. Now, first and foremost, the use of the cost method by the parent has absolutely no effect on what we do with the various non-controlling interest accounts. How the parent accounts for their investment has nothing to do with the value of the non-controlling shareholder's equity claim, nor with the income that we allocate to the non-controlling interest. All of that is exactly the same as it's always been. The difference under the cost method is going to show up in two places. After the first year, in that initial elimination entry, which I've always called the S entry, the parent's investment account will not equal the subsidiary's beginning of year book value plus remaining unamortized differential, or in the case of a partially owned subsidiary, the parent's proportionate share of the book value plus the remaining unamortized differential. This discrepancy will need to be recorded as an adjustment to retained earnings. Secondly, the elimination entries to eliminate the investment income and the subsidiary's dividends are combined since the parent's investment income is the dividends from the subsidiary. So let's go ahead and run through a quick example. Assume that big company purchases 100% of the voting stock of little company for $400,000. Little's book value on that date is $340,000, $100,000 of common stock and $240,000 of retained earnings. The entire $60,000 differential is attributed to undervalued equipment with a remaining life of 3 years to be amortized to $20,000 per year. Little reports earnings of $50,000 per year and pays dividends of $5,000 per year. So first, let's go ahead and account for the investment under the cost method. First, Big, of course, records their acquisition, and then they record their receipt of that $5,000 in dividends, recording that as investment income. When Big Company does their elimination entries, we'll have, again, their first S entry. They eliminate the subsidiary's beginning of year owner's equity accounts, common stock, retained earnings. They go ahead and carry forward the differential equipment value. So the total book value of the firm plus the unamortized differential is $400,000. And very conveniently, that equals the balance in the investment in Little. We record our year's worth of amortization, depreciation expense, and a credit to equipment net. And then finally, we eliminate the subsidiary's dividends declared against the parent's investment income. Now, so far, there's really nothing terribly difficult about this. At the start, the investment in Little balance of $400,000 equaled the parent's 100% ownership at the beginning of year book value plus unamortized differential. In year 2, however, things are going to be a little bit different. So before going any further, let's determine what Big's investment income would have been had they used the equity method. So in other words, what is the correct investment income given that the equity method is the correct way to account for the investment? So what Big would have recorded under the equity method, they would have recorded their share, 100% of Little's reported earnings, minus their share, 100% of the amortization of that differential. So they would have recorded investment income of $30,000. Under the cost method, they only recorded investment income of $5,000. They understated their income by $25,000. By understating their income in year 1, that means they're understating their retained earnings at the end of year 1 or the beginning of year 2. So that's what we're going to be adjusting when we do our first elimination entry in year 2. So moving on to year 2, Big is going to record another $5,000 of investment income. When they get to their elimination entries, again, they're going to go ahead and eliminate Little's beginning of year owner's equity accounts. Common stock is still $100,000. Little's retained earnings is now up to $285,000. Last year's balance of $240,000 plus $50,000 of income minus $5,000 in dividends. And they carry forward the remaining unamortized differential. So the beginning of year book value plus unamortized differential is $425,000. we're going to go ahead and close that against the parent's investment account, which is only $400,000. So there's $25,000 missing. That $25,000 is the adjustment to retained earnings to correct the parent's retained earnings account. We do another year's worth of amortization and another year's worth of eliminating the investment income against the dividends declared. Finally, in year 3, the same thing happens. We eliminate the subsidiary's beginning of year equity accounts. Now Little's retained earnings is up to $330,000. Last year's balance of $285 plus $50,000 of income minus $5,000 of dividends. We carry forward the remaining unamortized differential. So the beginning of year book value plus remaining unamortized differential is $450,000. We close that against Big's $400,000 investment in Little balance. The other $50,000 is again an adjustment to retained earnings because for a second year running, Big did not report enough investment income, which means they're continuing to understate their retained earnings. Last year's amortization and the last year's worth of investment income and dividends declared eliminations.